Welcome to the UK Mortgage and Property Market Update for the weekend in the 6th of March. If you're new here, I'm Craig and I've been helping people with mortgages for over 25 years. And every week I put together one of these updates to break down what's happening in the mortgage and property market and what it actually means for you. This week there's quite a bit to get through, so let's just dive straight in. We'll start with mortgage rates, and it's been a bit of a roller coaster week. At the start of the week, several lenders were actually cutting rates, which sounds like great news. But if I'm being straight with you, those reductions were almost certainly baked in from the end of last week, when swap rates had been easing off a bit and lenders were quietly adjusting their products behind the scenes. Then, as the week went on, the picture shifted. From around Wednesday, we started seeing some of those lenders putting rates back up again. And that's a direct reaction to what's been happening in the swap markets, where pricing has moved higher as financial markets get jittery about inflation and what's going on globally. Speaking of swap rates, it's worth flagging just how much they've moved this week. We've seen a pretty significant increase across the week, which is exactly why lenders have been pulling back on some of those early reductions. But when swap rates climb like that, lenders don't hang around. Their pricing adjusts quickly, and that's what we've been seeing play out in real time. Now, all of this feeds into something that a lot of people are watching closely right now, and that's the Bank of England base rate decision on the 19th of March, which is just under 2 weeks away. If you'd asked most people a little while ago whether we'd see a cut at that meeting, the answer would have been a fairly confident yes, but the mood has shifted. Given the inflation uncertainty that we're seeing in the global picture, we'll talk about that in a moment, a rate cut on the 19th is looking a lot less likely than it did. Markets are cooling on the idea, and honestly, I think the bank will want to sit tight to see how things develop before making a move. Now, that's a pretty meaningful shift in expectations, and it's another reason why mortgage pricing has been creeping back up this week rather than continuing to fall. And this is something I say a lot, but it's worth repeating. Mortgage pricing is not static. Lenders are constantly watching the swap markets, and when those move, rates follow pretty quickly, sometimes within hours. Now, if you want to keep up with those changes in real time, I post them on my Instagram stories as soon as they happen, so that's worth following if you like to stay on top of it. But the big takeaway from this week on rates: things can flip fast, so bear that in mind. Right, let's talk about the spring statement, because this one was, well, interesting and not entirely for the right reasons. So on Tuesday, Rachel Reeves stood up in the Commons to deliver her spring statement, and the government had been pretty clear beforehand that this wasn't going to be a big policy event. They want the autumn budget to be the main fiscal moment. So this was always meant to be more of a progress report. And on the surface, there were some positives. Borrowing is down nearly 18 billion compared to the autumn forecast. Inflation is falling faster than expected, now projected at 2.3% for 2026. And the government's line is that households will be around £1,000 a year better off by the next election. But here's the bit that really stood out to me. The OBR, the independent forecasters, buried a disclaimer in their report saying that their numbers were finalised before the escalation of US and Israeli strikes on Iran at the end of February. So essentially, the economic forecasters Chancellor was reading out were already based on a world that had changed by the time she was speaking. That's a significant caveat. So why does that matter for mortgages? Well, it's all about energy. If things escalate in the Middle East, oil and gas prices go up. Inflation goes back up, and if that happens, the Bank of England has far less room to cut interest rates. In fact, we could see pressure to hold rates where they are or even push them higher. And even without the Middle East factor, the numbers weren't exactly sparkling. Growth for 2026 was downgraded from 1.4% to 1.1%. Unemployment is now expected to peak at 5.3%, which is higher than what was forecast just 4 months ago in the budget. So what should you take from all of this? Honestly, watch energy prices over the coming weeks. If things deteriorate globally, the inflation story could look very different by the summer, and that feeds directly into mortgage rates. My honest advice is, if you've got a mortgage coming up for renewal, or you know you're going to need one in the next 6 to 12 months, don't sit around waiting to see how things play out. The deals on the table today might look pretty attractive compared to what's going to be around in the autumn if things go the wrong way. Okay, let's move on to house prices, because at the beginning of the week, Nationwide released their latest figures, and there's some quite encouraging stuff in there. Annual house price growth is sitting at 1%, the same as last month, and on a monthly basis, prices nudged up 0.3%. That puts the average UK property at just over £273,000, up from just under £271,000 the month before. So it's not a market racing away, but it is stabilising and slowly recovering. And that's actually the story we've been telling on here for a while now. Nationwide's chief economist made the point that this reinforces the idea of a modest recovery after the dip that we saw towards the end of 2025, a lot of which was driven by uncertainty around potential property tax changes ahead of the budget. But what I find more interesting than the headline number is what's happening with activity in the market. Mortgage approvals for house purchases are still running close to pre-pandemic levels, which is a solid indicator of underlying demand. And if you look at all of 2025, transactions were around 10% higher than in 2024. And perhaps the most encouraging stat is that first-time buyer completions were up 18% year on year. Now that's been helped by slightly better affordability and lenders loosening up a bit on credit availability. Home movers are coming back too. Transactions involving a mortgage were up 15% over the year. Buy-to-let is still quieter though, and I'm seeing exactly that on the ground. There's been a gradual increase in landlord purchases, but it's still subdued. Higher rates and ongoing regulatory changes are keeping a lot of investors on the sidelines. One other thing worth noting as well is that cash buyers still make up around 35% of all transactions. But that's actually down from a peak of 42% back in 2023, which suggests that mortgage funding purchases are playing a bigger role again, and that's a healthy sign. Overall, the housing market is slowly getting its momentum back. Not dramatically, but the direction of travel is positive. So what's the main message this week? It's really this. Mortgage pricing can shift very quickly. We saw that play out in real time this week. Rates down at the start, back up by the middle. And that's just how the reality of the mortgage market works. And I always say the same thing when people ask me whether to wait for rates to drop further. Don't try to beat the market. People do it and it regularly backfires. By the time you've waited for that slightly better rate, the window's often closed and rates have moved in the other direction. The smarter approach is always to base your decision on your own situation. Your plans, your finances, what actually works for you. And if you're coming up to remortgage or you know you need a mortgage soon, remember, in the UK you can usually lock in a rate a few months in advance. And that protects you if things move against you. If rates improve before you complete, you can often switch to a better deal anyway. But you can't go back and grab today's rate once it's gone. So stay informed, make decisions based on your circumstances, and don't let the noise of the market push you into doing nothing. Right, that's it from me this week. If you found this useful, please do hit that like button and subscribe to the channel. I do these every week. And follow me on Instagram if you want the real-time updates on rates as they happen. Take care, and I'll see you next week.